The information provided in this podcast is for educational and informational purposes only and should not be construed as investment advice. We are not financial advisors, and nothing discussed on this podcast should be considered a recommendation to buy, sell, or hold any security. All opinions expressed are those of the hosts and guests and are subject to change without notice. Listeners should do their own research and consult with a qualified financial advisor before making any investment decisions. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. All right. Hello, everybody, and welcome to the Value Cville podcast. I'm your host, Jeff Henriksen, here with my co-host, Donnie Sitar, and very honored, very excited to have Mr. Paul Johnson with us here today. Paul is a renowned thinker in investing and value investing, an educator, currently teaching at the Cville School of Business at Fordham University. And we were very fortunate to have the Cville School sponsor the Jeffersonian dinner at Value Cville this past May. Paul's colleagues, Rick Carew, hosted the dinner and posed the question that we all ruminated over for several hours, some really good food and bottles of wine. But I was not fortunate enough to actually have Paul as a teacher. I wish I would have. Now, I did learn a lot from Paul because his book, Pitch the Perfect Investment, I love the book on so many levels. If you haven't read it, please go out and read it. It is great. But Donnie, my co-host, was a student of Paul's. So I'm going to let Donnie do the proper intro here. But yeah, Donnie, over to you, man.
Yeah, thank you. Well, I am truly honored to have you on the podcast, Paul. Once a teacher, always a teacher. You've got a wealth of experience here. I'm just going to touch on a little bit. Currently the executive director of the Cville Center for Global Security Analysis at Fordham. 30 plus years now with Columbia Business School and the Value Investing Program. Taught over 3,500 students. I think it's some absurd percentage of the students you've taught at Columbia. You know, you co-authored a number of books that Jeff touched on. I think most importantly, though, what I really appreciated about learning from you is that you were in the seat. So you taught, but you spent 20 years as an equity analyst in tech, I believe, 10 years running a hedge fund. You've done a lot. You've seen a lot. You've been through all these various cycles. And I think whenever you do talk and whenever you're able to learn from you, it's because you've taken all this amalgamated, so much experience, real books, a classroom into where we are today. So I generally enjoy it and I'm honored to have you here today.
Thank you, guys. I always like to keep the expectations low in the intro, but maybe that's impossible. I was very flattered when you reached out to come on the podcast. I had a long relationship with Donnie. I actually met Jeff through another set of activities to find out you guys did this, what I think is a fantastic, the Value Cville. We were delighted to be sponsors. We want to be more involved with your activities. Certainly anything you do in New York, we definitely want to be involved in. We're going to continue the partnership and, around the Markel annual meeting. So for me, this is kind of, a continuation of what I hope is a very long and fruitful relationship.
Agreed.
Well, so we've got, one of the things I like about our podcast is we try not to over prepare. We like to just make it off the cuff and talk. I know there's a couple things we want to talk about and kind of just see where they go. But Paul, you've done so much work around valuation, practical valuation, specifically understanding the value of growth. And I think we're gonna. I know you've done a lot of lectures that are on YouTube. And with your permission, we can put links to that so viewers that are not familiar with your work can see it. But maybe just to start at a high level, talk a little bit about what brought you to really want to think deeply about the value of growth, what your approach was kind of when you were thinking and wrestling with these issues, and maybe some of the high level conclusions for some of our viewers that maybe have not seen your material. And then we can kind of take it from there and kind of see where the conversation goes. How's that sound?
Yeah, great. The journey started a long time ago, actually. I was a young analyst in my late 20s. I was a tech analyst. Initially, I followed the semiconductor industry and then ultimately followed the networking industry. I was the first analyst to publish on Cisco systems. Interesting. We weren't in the IPO, so I could publish before everybody else. Just took advantage of it. And when you saw companies like Cisco and before that Intel, and you saw these great Microsoft, you saw these great great tech companies that had these huge valuations and continued to support those valuations for a long time. The classic value investing of sort of we're looking for things that are less than their value conceptually, certainly in the if you look backwards, value investing had a lot of focus on balance sheets, less on income statement. And then these companies outperformed for a very long time and created enormous shareholder value. And so it just was this mismatch between kind of value investing, if you will, and growth investing. And I just, in my core, refused to believe that there were two different disciplines, as if value investing was one thing, and then growth investing was a separate, and they kind of were two different lands, never communicated. And I just refused to believe that because there had to be a connection. I had a very fortunate random event where I followed Lotus, a software company, for a while, and they had introduced Lotus Notes, which was the first groupware, the first beginning of kind of a network-based software. And they had an event in Florida for Lotus called Lotus Sphere. And I went to that, and the speaker was a guy named Jeff Moore, who I didn't know, hadn't seen. And he talked about a book that he had published called Crossing the Chasm. All right. So I had the opportunity to listen to Jeff Moore at the lunchtime speaker. And Jeff is a fantastic speaker. And he was talking about a book he had published about a year earlier called Crossing the Chasm. And I was a tech analyst at the time. And I was blown away by the book because it was this kind of missing piece, or a missing piece to my analysis, which was that a lot of companies had done very well with what he called early adopters, but getting into the mainstream market was really a challenge.
Right.
Different set of needs, and really a whole different approach to entering the market. But once you entered into what he called the early majority, then business took off. And as a tech analyst, I was really intrigued by this because obviously if you could figure out when they had crossed the chasm, that's when growth took off.
It would inflect.
Yeah, that, and a lot of interesting dynamics happen to the industry. If it's a scale business, winner take most, winner take all would emerge. You get these kind of pseudo monopolies, big valuations, if you could capture that. So I was very impressed. Came back to New York, and true story, this is before Amazon, walked over to the Brentano's bookstore and ordered 25 copies of the book and gave them out to everybody, colleagues in the department in tech, all my clients and things like that. And then second random event in life, I was on an airplane in May of the following year. That was December. In May of the following year. And I was flying from Palm Springs. I'd been at a tech conference to San Francisco, sort of head of Silicon Valley. And I was sitting next to a guy who looked very familiar, but I could not place a name. And he finally reaches over and he said, "Hi, I'm Jeff Moore." And I said, "Crossing the Chasm." And he's like, "Oh my God." And he, if you're on an airplane, somebody identifies you by your book. That's kind of cool. Yeah. So who are you? I told him my background. I told him I used the book. I'd seen him at Lotus Sphere. And then I mentioned just casually, I bought 25 copies of the book and been sending them out. Now, if you're on an airplane, somebody identifies you by your book. That's pretty cool. But if that person turns around and says they bought 25 hard copies, that's really cool. So now we're best friends. So he said, "Wait, tell me what you do." On a napkin, I drew a chart that is fairly famous at this point, where I just showed where using his work and some work I had done with Michael Movison on competitive advantage period, when you combine the two, you could explain these enormous performances and valuation, beginning of it. And he was extremely impressed. He said, "Wow, I hadn't thought about that." So at the end, I said, half cheeky, but I said to him, I'm trying to figure out is when do you know you've crossed the chasm?
Right.
That's the issue. And he said, "Oh, interestingly, I'm working on another book called Inside the Tornado, and I address that issue." So I said to him, this is absolutely true. I said, "If you need somebody to read an early manuscript, give you some feedback, big fan of your work, please consider me." Now, I didn't want to do that, but what I really wanted to do was read the book before anybody else.
Yes, get the knowledge before it's out. I totally agree, but that's great.
Exactly. And I knew what to do with it.
You do with it, yeah.
Yeah, maybe 6 months later, this is pre what we do now, in a FedEx package came a bounded manuscript he had printed out, a note and all that. So I started reading it. I was very, very impressed. Doesn't answer it perfectly, but very impressed. So I gave him some feedback and all of that, and sent that to him. And then the book came out, and I got a hand-bound copy of it, handwritten note and all that on the book. Very, very nice of him. And then he sent me an email and said, "I'm going to be in New York." This is now a couple months later. He said, "I'm going to be in New York. I'd love to have lunch with you." And I said, "Great. What's the topic?" He said, "We're going to write a book together."
Oh, shit.
I said, "Really? What's the book?" And he said, "The Gorilla Game." And I said, "What's it based on?" He said, "The napkin you gave me." And so that was kind of the beginning of the journey. And we did end up writing a book called The Gorilla Game with 3 authors, Jeff Moore, Paul Johnson, a guy named Tom Kippola, who was somebody in his consulting practice who also liked to invest. And the 3 of us wrote the book. And that was first published in 98, second edition 99. All right, so we could put a pin in that. But I really ran with that for a long time. Roll forward 20 years, and I published a book called Pitch the Perfect Investment, co-authored with Paul Sonkin. And we're effectively talking about the same thing as the Guerrilla Game, although from a very different angle. And after I got the Pitch the Perfect published and done and recovered, because writing a book is hard, it dawned on me one day that these two books were talking about the same elephant from two different angles.
Right.
And I was like, they've got to be an interconnection. And it took a while. It took me 2 years of drawing charts and thinking and modeling. And then one day, this is always fascinated by this story. One day I was walking near Lincoln Center, and it hit me that I had been thinking about it wrong. I mean, my brain had twisted stuff, and I knew the connection. And I sat down with a piece of paper and a pen and wrote it down because I was afraid it might disappear.
Right. They do. The best ideas, they can leave you quickly.
Wow, as quickly as they came, right?
Yeah.
The same exit that they came in. I then sat down, and it took 2 years of pretty continuous work to try to make it all work out. And then one day it all fell into place. And then that became what ultimately is what we call the value of growth, which was combining Guerrilla Game, the stuff Jeff did and the diffusion and adoption, crossing the chasm, the stuff I did with Mobison originally on competitive advantage period and what those charts look like, what Paul and I did in Pitch the Perfect, not on the pitching part, but on the valuation part.
Right.
It all came together in the graphics. And then that phrase I now use is value of growth. And I think we'll flesh that out. But that's kind of answers the first part of your question is journey. How'd you get here? Well, I've been thinking about it for a very long time and teaching it, which helps because you're going back over it.
Yeah. Right.
And trying to explain these concepts so we can understand. And once it kind of value growth fell in place, life became easier. I can look at, yesterday they announced that the new round for OpenAI is $500 billion. And I would say 5 or 6 years ago, I would just struggle with how could it be worth $500 billion?
It's a tough guy to swallow.
Yeah, now it's easy. You just stop and say they're paying a lot for future growth. Maybe right, maybe wrong. I mean, but once you do that, it's all right, fine. They're paying for a lot for future growth. We'll see over time if that proves to be a good bet or not.
Right.
The other one I always was fascinated by is a CEO of a startup would announce we've reached $1 billion. We're a unicorn. And they're celebrating. And I always laughed and said, no, you've just sold that set of expectations to some investors that have some control over your life. You've told them that at $1 billion, they're going to get an excess return.
Right.
So you shouldn't celebrate because you just signed up for an obligation that you may or may not be able to deliver on.
I like that.
If you don't deliver on, life is going to...
I think that's a great way to think about. I love that. That's excellent.
So that's all of that, what kept going into the blender and spinning until things came
Paul,
out.
One thing I just, maybe would help to tease out just some terms here for a second. So the crossing the chasm, competitive advantage, and then the third one is you have a book, Pitch the Perfect Investment, which largely feels like it's to quote unquote value investing students or acolytes. Maybe just tease this like rubber hitting the road a little bit. Okay, you're the cross the chasm part to competitive advantage to the pitching the perfect investment elements. I think that'll help maybe just flush out the story more and kind of get us into the rubber hitting the road.
Yeah, so we almost have to work backwards. So if you take a company, Amazon or Google or Meta or any of these companies that are growing relatively fast, that is kind of a normal-ish growth rate, or they're approaching a normal growth rate. And there's a valuation problem for that. But if we go a bit earlier, when companies are growing very fast, and I have a loose definition, and then I'll give you a specific definition. Loose definition is these companies are growing at 20+%. The question you have is, how do you value that? And so you keep going back and you stop and say, well, how did they get into a position that they could grow that fast? Well, they entered into a market that was very large, that they had the right product fit, and it kind of takes off. But what really happens is that the cost of customer acquisition starts to fall in that people start to find them. People have budget. If you're a corporation, if you're an individual, you're a motivated buyer. So your cost of customer acquisition starts to fall fairly quickly, which means you can scale the business very fast. All right. So then you kind of go, well, how'd they get in that position? And that's where Jeff Moore's work was really helpful. Jeff was a high-tech marketing consultant He had worked for Regis for a long time and then spun out on his own. Regis was the original high-tech marketing guru in Silicon Valley, Regis McKenna. McKenna Associates, I think was the name of the firm. And what Jeff kept noticing is that you would have these companies that did really well and then stalled out. And he kept thinking, why are you stalling out? So the original work goes back to 1962. A guy named Everett Rogers, he wrote a book called The Diffusion of Innovation. Keywords. Diffusion means how does this expand into a population? And this was a key insight into all of that, which was really important. Oh, look at this.
Yeah,
Copy. This was really great.
I do keep it handy to look at. So
This is growing now as we speak.
Very important. And what Everett Rogers really talked about there, we have innovation, adoption, and diffusion kind of thinking about it. Innovation is something new. The full definition of innovation is new and useful. That's the terminology. New and useful, not just new. A lot of people think of creativity as new. That's probably fair, but innovation really is new and useful. We need that second piece.
Right.
The best team at that, I think, in technology was Steve Jobs and Johnny Ive, where Johnny was unbelievably creative at new and different things, and Jobs was brilliant at making them practical and easy to use. And the combination of innovation and editing was very powerful. And what Jeff noticed is that you could get early adopters to buy the product, but early adopters were kind of that motivated buyer. They had a problem to solve, or they were believed in the mission or something like that. But a practical buyer didn't trust an innovative early adopter because early adopters are willing to roll up their sleeves and make the product work. Whereas the majority, it's no, I have problems to solve. I have a business to run.
Right.
And so in that case, they need something to work as advertised, the full product. And so what Jeff identified is that there's a chasm between the two buyer behavior. It was really helpful. So that became kind of crossing the chasm. How do you go from a niche kind of product where your customers are going to tolerate that it doesn't always work, that they're going to have to do some work, but it solves their problem very specifically. They're willing to do the work. They're in a lot of pain. They want to solve that problem. They're willing to get in there. The pragmatist, the early majority, has no patience. They have no ability to work. It's got to work as advertised. And so Jeff said to cross the chasm, you have to finish the product. And then there's a bit of a catch-22, which is you have to get into the early majority to be able to have reference accounts that are in the early majority. And so in the second book, he talked about building that strategy. So when I said to him on the plane, hey, I'm trying to figure out how you know you cross the chasm, it really was, how do you start to win those early pragmatic customers so that they then become references for other pragmatic customers? That product works. And when Donnie calls you up and says, hey, I see I think you guys were talking about your new coffee. How is it? You say, it's fantastic. I love it. That's a reference sale.
Right.
And that's what Jeff really identified. And then if it's a big market, and in fact, there's a deep need, once you cross the chasm, you have practical, what he calls pragmatic. He really calls them pragmatist in pain, or the early part of the market. Then they start to become reference accounts, and you get this viral marketing. And that's why I mean that the customer acquisition cost starts to fall, because you have this great reference network that's starting to change. The second phase.
Real quick question there. So with the falling customer acquisition costs, kind of a minimum efficient scale dynamic, right? Once you reach a minimum efficient scale and your competitors can't match it, now you really have an advantage. So does that happen right after you cross the chasm? Is that
It can. It depends on the business model. So what we've really teased out in the guerrilla game is software, platforms, SaaS. Those models tend to be scale businesses.
right?
Whereas hardware is not a scale business, because you have this problem, you have to build something. So software scale, it's got that high fixed cost, almost zero incremental cost. That lends itself to that lower customer acquisition. Hardware, the next device, it's going to cost you less because of Moore's law, because of efficiency, because of experience, but that is very gradual erosion in cost, or that cost. So it's really software platform. But Jeff, you touched on something that's really important, which is some markets are winner take all, winner take most. And then it's a race to scale.
Okay.
One of the great phrases that people talk about is first mover advantage. It's not, it's first mover to scale advantage. And that's what you were just talking about, that if I have a business model that lends itself to scale, lends itself to one or two vendors, then that race to scale becomes important. And once you get there, you have effectively a monopoly position. So
Okay.
that's why that crossing the chasm, getting into the mainstream market is really important. The full product, the product the pragmatist will use, the pragmatist will recommend, and that's what drives that virtuous cycle all the way up.
So now you've crossed the chasm. You kind of are now, I mean, at least in the Jeffrey Moore early, the books, I mean, maybe I haven't, it's been a while since I've gone to that, but you kind of get this hyper growth phase almost, right? If you've done it successfully, right? And I think that's where maybe it starts to touch on where you are today.
Correct.
Is
Now,
how
there's
do you
two pieces.
value that? You've crossed the chasm.
Exactly. And so the two pieces that become incredibly important is the following. And I can walk you through it. Visually, it's very powerful. I'll walk you through it. Let's just say you're discounting some cash flows. And Jeff, you're sort of the expert. You teach this. So walk through the following. If the growth rate is higher than the discount rate, those incremental cash flows, present value of those incremental cash flows are growing. Whereas if the growth rate is less than the discount rate, those future cash flows are getting smaller and becoming less important over time.
Right.
But think through this. If I'm growing faster than my discount rate, all of a sudden, each year I can do that. I generate in present value terms, I generate more than I did this year. That next year generates more in present value. And that's hypergrowth. That is the definition of hypergrowth, is when you grow faster than the discount rate.
Well, in a model, in a period like that, you know, DCF doesn't work, you know.
Wait.
Yeah. Well, okay, fair point. But like knowing how long that period is going to last, and then you can get to a stable state or steady state. That's the trick, which is hard, right?
Yeah. All right. And put a pin in that, because that we solved that problem. I agree. We've solved that problem. So that's number one, is this insight that if you grow faster than the discount rate, every year you can do it. You create significant value. Second piece to that is if your return on capital is greater than your growth rate, you generate cash while you grow at this fast rate. So now if we put those pieces together, grow faster your discount rate, you're going to create enormous value. Have a return on capital greater than your growth rate, you're going to generate cash and grow at this great rate. That is Lollapalooza. So that is sort of the key. That is the hyper growth nirvana. And these scale businesses have that.
I would love to see your I'm sure you have charts on this too, because that, I mean, that as I'm walking through that in my mind makes complete sense. And it is one of these things that it's you need to be in that mindset to value something like that correctly. And this gets back to the value investing kind of framework, because I think a lot of value investors just, for whatever reason, have a hard time making those type of projections or are comfortable with projecting something like that, which is why a lot of these compounders, I mean, Google's a great example, just remain perpetually undervalued. I think, you know, I think tonight you're having Brett Cochran at Fordham, right? Well, I saw a lecture he did where he went back and reverse engineered a DCF based on Google, and he tried to figure out what the right multiple to pay if you had a perfect crystal ball, right? Back in 2004 or 5, what multiple, what PE multiple should you be willing to pay? And the number was crazy. It was like 400 times earnings or some big number. And it's just, it's so non-linear that I just feel like we as investors oftentimes, or at least some of us, and I used to be this way, have a hard time just getting comfortable with that.
Yeah, and I think
companies just stay perpetually undervalued because of that. That's kind of my view.
I would push back on a little bit of what you said, and we solved a lot of those. That's why I'm excited about value growth. We solved all these problems. We could explain now all these problems. And what Brett's doing is sort of misleading, because what he's saying is if you had perfect knowledge and you only needed a 12% return, then you would pay 400 times earnings, right? All right, so fine. What if you want a 20% return? Well, then it's more like, 200 times earnings. But I think that's non-operational. So Donnie asked something a moment ago that I want to add, because it becomes important. And then I'm going to come back, Jeff, and show you how we've solved these problems.
Okay,
so Donnie then said is what we care about is the duration of those cash flows. And there are two components of that: growth, which is clear. And Jeff, you're right. If we're going to use a traditional DCF, it's hard to model. Put a pin in that. But the second piece is the ability to maintain that competitive advantage, because as I said, the return on capital becomes incredibly important. And it's going to be two reasons. I'm only talking about one now, and I'll talk about the second one in a minute. And that is you got to be able to fund that growth. So that's part of it, which then means you have to think about barriers to entry. And so competitive advantage period, which Michael Mobison and I talked about in 97, was this idea: how long can you defend yourself? So that becomes part of this as well in this whole thing. So we care about returns, we care about incremental returns. So that was, if you will, the kind of the state of the art for me thinking late 90s through most of the 2010s. When I started writing the book in 2013, the Pitch the Perfect with Paul, he really is incredibly creative. It forced me to rethink some of these things. So, Jeff, we know that a DCF is broken, and it's broken in a couple of ways. Number one is we teach that there's an explicit period, 5 or 6, 7 years, whatever, and then we plug all of the cash flow, all the value beyond that in the terminal value. And the terminal value is 75%. So
yeah, right.
nothing. Now, I do think there's value to doing an explicit in that you're going to learn about the business, capital intensity, profitability, working capital needs. That's valuable. The terminal value is useless. Useless. Don't do the exercise. So now we have to have a tool that comes up with it. And this is where the value growth became incredibly powerful, because what we do is we separate the problem into two issues, or separate the challenge into two problems. Let's create a steady state cash flow that's going to last forever.
Okay.
Now, everybody will know, they'll either be reminded or they already know that if I have a steady state cash flow forever, it's a perpetuity. I can use the perpetuity valuation formula. It's trivial. It's just divide by your discount rate or multiply by 1 over your discount rate. Now, I use 10 as a general rule. We can spend time on that, but it just makes it easy. That is earnings power value. That's the right definition. Graham had the wrong definition. That's the right definition of earnings power values. What would this business earn if it maintained its current position forever? No growth, steady state, valuation, earnings power value. All right. That is where we spend all of our time as analysts. We spend, what is this company going to earn? What is competitive advantage? What's its return on capital going to look like? We do forensic analysis. We do scuttlebutt research. All of that is really aimed at blue. Management's primary focus is to increase blue as much as they possibly can. The problem is that earnings power value only accounts for some percentage of today's value. So if I take enterprise value, I subtract off the earnings power value, I'm left with this plug figure. Right. Well, it doesn't take long to turn through it and realize that's growth. That is what investors are willing to pay for future growth. So we call earnings power value blue. I always label it blue, and then green because of growth. The top part is the market implied and value of growth. Market implied because that's what the stock was telling you. Value of growth, it's that residual. And now we can sort of track that over time. You can let it historically, you can look and see what you think it's going to be. Now, if these tools were hard to use, or you had to build this incredibly elaborate model, or we had to do differential calculus, then I would say, I don't know if it's worth it. They're so shockingly simple to use that everybody should use them. I'm not saying replace what you're doing, but use them, because what I can do is come up with a value of what I would pay for this company if it earned this amount of money on a steady state base forever. Now, I often hear practitioners and students, I'm not comfortable with forever. I've said, yes, you are. Every multiple you've ever used, whether it's an EBITDA multiple, a PE multiple, price for revenue, whatever multiple, it has forever embedded in the assumption. So you've been comfortable with forever, your whole career. All I'm doing is making it explicit. So then people say, well, I'm not comfortable. I said, well, then come up with the highest NOPAT you're comfortable with over the next 10 years. That's your earnings power value. He said, well, what if earnings are depressed? Use a higher number. What if earnings are, I think, a little high? Use a lower number. You can decide, and you can do research around that. That's your earnings power value. Here's the trick. The residual, which I call the market implied value of growth, market implied because it's being dictated by the stock market, that is animal spirits. That is expectations. That is what investors believe. So blue is really dictated by the company. Green is dictated by investors. The moment you separate those two problems, I think you have a much better way to look at the situation.
You know, Donnie, I know you have some questions here. I just want to say, Paul, as you're sitting here talking about this, one of my favorite books is Annie Duke's Thinking in Bets. If you haven't read Thinking in Bets, please, it's a great book. But one of the things she says in there is a mistake people make when they're making decisions under conditions of risk and uncertainty is they try to focus on what they know, what they're sure of. And they're a little bit like uncomfortable embracing this idea, I don't know. And one of the things she says is, really good poker players and decision makers, they focus on how uncertain they are about something versus how certain they are. And they make a decision based on the level of uncertainty. That has always stuck with me because I think it's so right. The approach that you're arguing for, it feels like, I need to think about it a little longer, that it lends itself to that type of thinking. What do you think about that? Because if I understand what you're saying correctly, we're looking at the market implied value of growth and looking at how it's changed through history and trying to figure out how we feel about that number as a percent of the total, I guess.
Yeah, exactly right. Exactly.
And I'm thinking an over under on that number. Am I understanding you correctly? And how would you think about that in
Yeah,
terms of kind of
yeah,
that level of uncertainty?
I think you've framed it very nicely, which is green is investor expectation. Blue is performance. Now, this is where we were 2 years ago. And since then, we've added some bells and whistles to it that make it even, and there are two key pieces to that whole thing. I mean, two very key pieces, but exactly right. For me, the moment I got this and it sort of grokked it, great engineering term, it was like, all right, now everything made sense. That's now go back to OpenAI. We can go look at the business and say, this is what I feel very comfortable that they can earn this over the next couple of years, add some growth if you want. Everything above that is growth above that set of expectations. So you can either use a steady state earnings power value or your own level of growth. Just say, I think this thing can grow at 7-8%, not OpenAI, 7-8% for the next few years. Model that in. And then anything above and beyond that is expectations greater than 7%. So we can actually start to tease out what investor expectations are on growth from a fundamental perspective. Donnie, I think you had some questions which we could circle back for. I can keep going.
Yeah, no, I mean, look, one statement as I prepared for this and was looking at some of the materials you sent across, my instinct was that, DCFs are broken and Paul's trying to fix them. And that's what it kind of feels like, is that, and you guys teach this stuff, so you probably spend. I just, maybe contextualizing this concept of the market value growth today versus, call it 2010. So we have some number that the market is, because even if you're, let's say, nothing, passive 401k investor, and you invest in the stock market today, you inherently are actually taking a bet on the market value growth. I mean, that's just, there is no one who's not making this bet, at least as, and I looked at your material, so I have a little bit of a view. I mean, I have I guess, inside view on that. But maybe just explain, how has this evolved over the last 15 years, right? Because, is it all in multiple expansion? Where do you see this, I guess, in the numbers? But maybe just discuss at a high level, a very simple level, this concept, how it's evolved.
Yeah, you said something there, Donnie, that's, I think, incredibly important and another problem we solve, which is multiple expansion. So let me answer your question directly and then riff on that statement for a moment. If we go back 15 years and we have very good data, the market implied value of growth has increased from about 10% of valuation to 65% today.
Mhm.
Market implied value growth today is 65% of overall valuation. I'm not a big fan of the phrase markets overvalued because that's a judgment call. So I tend to say the market expectation. The market expectations today, using market implied value growth as a measure, have never been higher. Now, are they right? We'll see. They seem high. I mean, we know they're high. They seem a bit too high in that, and when you look at something like the S&P 500, which is really driven by the economy, we have to talk about the Mag 7 for a moment, the economy, it implies that the earnings are going to grow at 6.5 to 7%. And I can explain that if we want. And that just seems high by historical levels. So I feel more comfortable saying that growth expectations have never been higher. And if we tease out the numbers, some of those bells and whistles we've been able to get to, then the growth expectations seem high. I mean, maybe somewhat unachievable, assuming that valuation will follow fundamental value over time. Now, you said something about PEs, because with value of growth, the moment you have this value of growth model, I can explain PEs in very simple terms. What would be the right PE for a company that didn't grow? Sort of 1 over its cost of capital, maybe a little premium for whatever. So today, the cost of capital for equities is about 10% if we go through the math. So maybe it should trade at 8 to 10 times earnings or something like that. That's what it pays. PEs above that are growth PEs. So we've been able to now instantly say, wait a minute, a PE above that baseline, you're paying for growth. And then you get into this game of how much is the right amount. We've kind of solved some of that problem. But I want to go back now to a really quick mental exercise. Why do stocks go up? How would it go up? There are really only, we'll call it 4, but 2 practical, 2 less practical. 1, you grow earnings and hold your PE, right? Stock will go up. 2, you grow earnings and your PE expands. Stock will go up. Those are the 2 kind of operational. Second one, the third one is that you keep your earnings flat and your PE expands. Now, by the way, that's what Apple was, is they didn't really grow their earnings other than in COVID because of the increase in people purchasing stuff for home. but the PE expanded dramatically, and that's what really benefited Buffett. We talked about that. The fourth case, which is really unusual, is your actually earnings are going down, but the PE is going up faster because maybe the company is investing in something that's going to take a little while to get the infrastructure in place. And once they do, everyone agrees they're going to take off. That's the unusual. So the two practical ones are grow PEs, hold your PE, or grow earnings and expand your PE. So it seems to me we got to figure out what drives PEs. And out of the value growth methodology, it's very simple. And that is that PEs, that excess PE is essentially the market implied value growth. What drives that is investor expectations for growth and investors' expectations for incremental return on capital. So PEs hold if long-term growth rates stay consistent. 1 year from today, everyone says, you know what? I think the growth rate is about the same as it was a year ago. If earnings grow, the stock will increase. What is your return? Essentially that excess, the cash that they generated in that year, plus the growth, right? So that is, we can tease all that out. All right. But it's incumbent on one condition, that the incremental return on capital in a year is the same or better than it was before. So PEs hold if long-term growth rates hold 1 year later and incremental return on capital does not shrink. The PEs expand if long-term growth rates increase or incremental return on capital is going up or both. So now we go, all right, this makes perfect sense. Now, here's the good news, which I love, is compounders. Now, if I won't do this because it's unfair, I've won this too many bar drinks, is that I meet people and they say something about compounders and I say, define a compounder, and they can't do it. They'll just say, well, long-term grower, all this stuff. All right, fine. A compounder is nothing more than a company that grows. At the end of the period, when we're assessing if it's still a compounder, the growth opportunity is as big as it was before, and the return on capital is holding or getting better. That's a compounder. And as long as they can do that, it's going to continue to perform well. Go look at Costco. Costco's market implied value growth has actually expanded over the last 10 years as people have got increasingly confident in them being a compounder. So this now, we can use this vocabulary, this language to explain all of these things that I think are, pretty
Well, but just, yeah, and maybe just play back for a second here is that, the market as a whole is priced in a lot of growth today. So the market value of growth, so the blue is pretty steady over the last X amount of years, but the market value of growth today is much higher than it was 15 years ago. Correct. And I think it's important to maybe double click on the word growth, because we started this conversation talking about guerrilla games. And so we maybe painted the brush growth in top line revenue. But I think there's an argument today that we are talking that the path to efficiency gains to leveraging OpEx may be higher than it's ever been. You were an equity analyst in the early days of the internet, so I would defer to you in that regard. But I do think there is this argument that maybe it's not. I think there's been some research out there that I think it was 16% of, increase in net income just off of, very easy efficiencies from AI. Do you think, how much you think of growth as not necessarily just top line, as these other elements to growth?
Yeah, I think it's a great comment. When we talk about growth, it's NOPAT growth. It's not revenue growth. It's NOPAT growth for sure. We know that unequivocally. And I agree 100% with your comment that we tend to think of revenue growth as growth, but it's net income growth. Net income growth is revenue growth and changes in margins. Okay, great. So now we tease back into your question of efficiency. Can efficiency grow bottom line faster than top line? Answer is probably yes. But now we come back to competitive advantage. So let's just take AI for a moment. AI is a general purpose technology like the internet, and therefore it's going to be available to everybody that wants it. Not everybody will implement it well, but let's just say those studies, and Bain came out with one study that said between 15 and 20, and that we kind of fixated on it. Here's the question. So if I increase productivity, operational productivity at a company by 15 to 20%, let's pick 15 for narrative's sake. The question is, who gets that benefit? So there's three potential places we could get that. One, shareholders. We pass on all that increased profitability to shareholders. Two, we take some of that for our employees. We reduce the headcount, but the people we have are more important. We give them more money. Or management takes a bigger chunk, which I promise you, if efficiency goes up, they're going to take a chunk. No question.
Private jets, baby.
And then third would be customers, because we lower prices. Now, if everybody has access to the technology, it's not a competitive advantage. And
Yeah.
therefore, a chunk of it will go to customers because there will be a company that says, hey, our cost of delivering the product is lower than it was. We want more growth. We're going to go try to capture market share, and that's going to force that. So depending on how competitive the industry is, more of that benefit's going to go to the customer than it's going to go to shareholders. The better the business is, more of that's going to go to management and shareholders, would be probably the way you'd see that. Okay, so that's a pretty good operational model. The one thing I want to keep in mind, and this is, I'm talking on AI tonight, and this is what I kind of uncovered prepping for my talk, is adoption and diffusion are two different concepts. So adoption is a few people start to try it. Diffusion is it rolls through an organization. And we have two great examples, electricity and the internet. And both of them took decades. 75 Business Week wrote a forward-looking article on the paperless office. And 50 years later, all of us, no, I don't, but most people have less paper in their life through iPads and PCs and email and stuff like that. So it is happening. It takes a while. The dynamo, which was introduced in 1882, started to show up 40 years later. So if AI is as important as everyone says, change it, the diffusion is going to take a while. So I wouldn't price that in, although I do think some of that is priced in. I think you're absolutely onto something.
Yeah. So Paul, I just like maybe just stepping back to some more of the first principles questions here. I think about the work that you're doing. I think it's important, and I think you've seen now 30 years of teaching value investing. You've seen the evolution in value investors, right? So if you go back to Buffett changing from being this true Ben Graham investor to buying great businesses at a fair price, and now it's almost like the calculus is, it used to be, at least what I recall 10 years ago, buying, don't ever pay for growth and you get the growth for free. Buy the company at the blue, as you like to call it, and then you'll get the growth free. But now it's, you're pay for the future growth. Just don't overpay for future growth. It seems like there's a little bit of an ex post way of saying, backing into how can you invest in all these great businesses that made all this money over the last decade. And that's just a question that I've been personally struggling with. And I've just evolved a lot in my own thinking in the companies that I look at, in the last decade. But maybe just to understand, how do you think about this in the value, kind of the traditional value halls from not paying for growth? And now we're putting a number on this growth and really making an assessment on whether we pay too much or pay too little.
And let me, before you answer, Paul, I'll add one wrinkle there, which is, I know that Mike Green pretty well and his thesis on the way passive is affecting the markets, which seems to me to be a mechanical micro market thing that could be causing a lot of that value of growth to increase. So how do you think about that in connection with what Donnie just asked?
Yeah, let's take the second one first so we can kind of tie it down, then go back into Donnie's question. I love your setup, Donnie, and the way is Mike Green and I have become good friends. We had breakfast last week in New York. We talked a lot about this. I have incorporated a lot of his work into my teaching because I think it's an important angle. And then as a full disclosure, Miles Thompson, my good friend, and I are publishing Mike Green's book next year. So we have some, this crazy work.
Yeah.
This podcast. Yeah, 100%.
Yeah.
So what Mike Green says is that he makes a couple of, says a lot of things. The stuff I take away, and this is what I tell him I take away. He says, look, if we look at flows, and he was a big believer that flows set price because that's who's buying and so on. We look at flows in 1995, 80% of the flows were what we would call traditional active managers, picking stock. Today, they account for less than 10% of the flows. 1995 segment, harder to capture, but good estimate is about 10% of the market. So professional money managers to retail was 8-1. Today, retail investors are about 17% of flows. So they're 1.7 times bigger than passive than active managers. If you go back to the 50s, we had similar kind of numbers. And in those days, the thought was that retail were more driven by behavioral, more trendy, more faddish, and they were kind of the punter at the table you could take advantage of. So ironically, we're back there to some degree. Passive investing, which started as a brilliant idea, you don't outperform the market, but you don't underperform the market and low fees, is now, he believes, 60% of flows. Now, that number is debated by a lot of people.
Right.
So I'm going to throw out the case. Cliff Asness said on his recent podcast with at Columbia with Tano and Michael Mobison, he said, we do know if passives got to 100%, that's Armageddon. That's not good. And at 99, it might be the same thing. And at 90, it's probably the same thing. As this gets bigger, this becomes a problem. Now, all that's interesting. What I care about is two things. Number one is it sure fits the fact pattern with valuation going up because now flows are so big. Everyone says it's passive. Mike Green says they're not passive. They just have the dumbest investment algorithm you ever met, which is if cash goes in by the market.
Yeah.
All right, that's fine. That's fine. That's fine. Now, one of the questions which people have struggled with a bit is, and there's a paper out of Harvard that says who sells? Everything's an exchange. So who sells when passives buy? And it ends up it's corporations through stock issuance and options and things like that. And that works out almost one for one. Shocking. All right, fine. So companies have taken advantages mostly through stock-based compensation. All right, here's the question I care about, and the only part I care about: who buys when passives sell?
Well, I mean, it's either going to be retail or active, right?
Yeah,
Or a
stock
company
market
buying back their
managers.
stock.
Yeah,
But
by
asset
definition,
managers
actors, yeah.
are tiny today, and they don't have a lot of cash. So there is an Armageddon here where if passives started to see negative flows, which we could talk about, then cover bid, I will argue the cover bid's down 50%. That's the cover bid, down 50. So if we started to see money come out of passive, then we have a serious problem, not a small problem, serious problem. So then how does money go out of passive? Mostly employment. So if in fact you've got some crazy economic theories being tested, I'm not going to take any political stance, but I just know as an economist, some of this stuff's never been tried before. The theory's pretty well accepted, but we're going to test it. We're going to do an A/B test at economics, which we rarely do. If you, in fact, crunch this economy and unemployment went from whatever it is today, 4 to 6.5, 7, 8, we're going to see flows come out of K programs. So they're going to stop going in and then maybe come out as people withdraw from their 401k just to pay rent and buy food. Then we're going to test all of these theories. So I think that's a factor that we just want to think about. Now, Donnie, you said one thing, I'm just going to tighten it up. It's not so much that it's driven the market implied value growth. What it does is it has effectively forced the market implied value growth to fill in that gap, which means that if we're looking at it from a fundamental perspective, we're back to growth expectations are very high by historical economic trends. And therefore, if we have to revalue those based on a more realistic economics, again, we're down 35 to 40% just on that. So, that's why I look at this and see, I think the market's become fragile. My friend said, you're such a doomsayer. I said, I'm not a doomsayer. As long as you think flows are going to go, I would be long the S&P 500. It's making new highs every day. There's no reason. My mom's 91. I said, Mom, look, this issue is going to outlive you. Stay invested. Don't try to call the market.
Yep.
I do think this is going to take a little while, but I feel some responsibility to thinking about this.
Yeah, hopefully they can print money for the next 40 years or so, however long I'm alive.
Thanks for listening to part 1 of our conversation with Paul Johnson. Stay tuned for part 2 coming soon. Subscribe so you don't miss an episode.